And war broke out. Let's see what happened then. Let's see what happened to the stock market at that time. Okay. Get serious here. Business take care. Talk about the Yom Kippur War. I know it's a long time ago. Doesn't mean anything. This could be happening here. Okay. Don't forget to subscribe to this channel. Giving lots of information here. We need the support as usual for this channel. What that means? It means subscribes, thumbs up. And if you want to talk about something very specific and you want to see what I'm doing, I'm live every day between 8:30 and 8:45. I'm uploading some special videos, talk to special guests, and all this for my my members. October 6th, 1973. It is the holiest day in the Jewish calendar, Yom Kippur. Streets are quiet. Most of Israel is fasting and at prayer. And then, without warning, Egyptian and Syrian forces launch a coordinated military attack on Israel. Now, you're thinking, okay, but is this a history channel? No. But how does a war of some 50 years ago have to do with my money in 2025, 2026? Because what happened in the financial market, over the next 12 months, and after that war started, is one of the most dramatic, more devastating, and most educational case studies in the history of investing. And here's the thing. The same forces that destroyed portfolios back then, they're still alive and operating in the world right now. So I'm going to walk through this chart that tells this entire story. And we're going to read it together, line by line. And by the end of this video, you're going to understand exactly what happened, why it happened, and what it means for you thinking about your money today. So first of all, let's break it down what we're actually looking at. That is very important. And I know those charts can feel intimidating, trust me, but first of all, the title. At the top says a 3-week war. That is our anchor. This whole chart is telling the story of what happened to financial markets because of a war that lasted just 3 weeks. Again, when you look at the bottom of the chart, that's your timeline. It runs from January 1973 all the way to the end of 1974. So we're looking at roughly 2 years of market history. Think of it like a road. You start on the left and you travel to the right through time. Now look at the left side of the chart. You'll see some numbers, 60, 70, 80, 90, 100. These aren't dollar prices. They are what's called the rebased index. Both lines, the blue line and the red one, both start at a value of 100. And that's the baseline. It was set on October 6, 1973, the exact day the war started. So when you see either line go above 100, that means it went up. And when it started, and when you see it go below, that means it went down. That's basically what it shows. So we start at the same time. Think of it like this. Imagine two runners, both start at the same starting line on the same day. One runner is a US dollar, and the other runner is a stock market. The chart shows you exactly where each runner ended up after 2 years. Now, there are two lines on this chart. The blue line on the top, that's the US dollar index. It measures how strong the American dollar is compared to other major currency around the world. And that's important because you want to understand what you're looking at. The red line is starts near the top as well and ends up way down at the bottom. That's the S&P 500. That is the stock market. It tracks the 500 largest companies in America. When that red line goes down, it means the average investor is losing money, a lot of money. So let's get that out of the way. Do some... Now there's a dotted vertical line. See that dotted vertical line running up and down around October 1973? That's the moment everything changed. That is when Yom Kippur War began. Everything to the left of that line is the world before the war. Everything to the right is at what came after. And here's what makes this chart so powerful. The moment that dotted line appears, you can literally see the two lines splitting apart. The blue line that shoots up and the red market line falls off a cliff. The divergence, that split, is the story. Let's talk about why it happened so you could maybe draw some conclusion as to what's going to happen in this market under this particular war. But real quick, if this kind of analysis is new to you, and let me explain to you how to read the chart. So this channel is dedicated to one thing: making financial markets understandable for regular people. Regular people who want to protect and grow their money with real knowledge. So if this resonates, don't forget to subscribe. And every week I provide content like this not as a financial advisor, but as an educator on my channel and for my members. Okay, so back to the chart, because this is where things get really interesting. Let's set the scene. It's 1973. The United States has just come out of the 60s, a decade of protests, social upheaval, and the Vietnam War. The U.S.'s economy is feeling the strain. Inflation is creeping up. Does this sound familiar? And globally, tensions in the Middle East have been simmering since the 1967 Six-Day War. Does this sound familiar? Where Israel captured significant territory from its Arab neighbors. Egypt and Syria want that land back. And on October 6, 1973, knowing Israel would be at its most vulnerable, the holiest and most sacred, they strike. The war lasted about 3 weeks. And Israel, after early setbacks, eventually pushed back with massive U.S. military support. And ceasefire was declared on October 25th. 3 weeks, that's it. The actual fighting, 3 weeks. But the financial consequences, those lasted almost 2 years. And that is what this chart is showing you. And here's why. The Arab member nations of a group called OPEC, the Organization of Petroleum Exporting Countries, They were furious at the United States for supporting Israel. So they did something that shook the entire global economy. They turned off the oil tap. That is known as the Arab oil embargo of 1973. OPEC stopped selling oil to the United States and its Western allies overnight. The price of oil quadrupled from about $3 a barrel to around $12 a barrel in a matter of months. Now think of what oil means. Oil isn't just gasoline for your car. Oil is the engine of the entire economy. It powers factories, it heats homes, it moves goods across the country. When oil quadruples in price, everything gets more expensive. That was the match that lit the fuse, and the explosion you can see right here on the screen is the red line collapse. So let's look back at the blue line. Let's look at the blue line. The dollar index, notice something interesting. Before the war starts in the first half of 1973, the dollar is actually falling. It's declining. It was already under pressure from economic problems in the US. Inflation was rising. Does this sound familiar? The economy wasn't great. When the war starts and that blue line does a complete 180, it starts climbing. Does it sound familiar? And climbing until by early 1974, it's up to 15% from where the war started. That dashed circle in the chart, right around January to April 1974, that is the peak of the dollar's rally. Why does war cause the dollar to surge, as it is surging right now? This is really important concept that plays over and over in history. When the world gets scary, when there's conflict, uncertainty, instability, global investors do something instinctive. They run to safety. And for the last 80 years, safety to the global investor has meant one thing, the US dollar. Think of the dollar like a financial bunker. When the world outside gets dangerous, people crowd into the bunker. All the demand for dollars from investors in Europe and Asia and Latin America, all wanting to hold dollars, drives the price of the dollar up. That's right. But there's a reason why the dollar surged significantly, specifically in 1973, and this one is crucial. Oil is priced in dollars. It's been that way since 1940. Every barrel of oil on the planet, from Saudi Arabia, from Iraq, from Venezuela, is bought and sold in US dollar. That is what is called the petrodollar system. So when oil prices exploded, when the cost of every dollar quadruples, countries all over the world suddenly needed 4 times as many dollars to buy the same amount of oil. Demand for dollars goes through the roof, and when demand goes up, the price goes up. That is your 15% dollar rally. Looks like the victory on the chart, doesn't it? The blue line surging upward, looks strong, looks powerful, but look at what's happening to the red line. The red line at the exact same time fell 45%. That red line, the S&P 500, is one of the most heartbreaking lines I've ever studied. And I say heartbreaking because that wasn't just a number on the screen. This was people retirement savings. This was people college funds for their kids. This was real families watching their financial future evaporate. Look at where the red line starts when the dotted line appears. Right around 100. And then look at where it ends up by October 1974. Just 1 year later. It bottoms around 57 or 58. That is a 50 to 43 to 45% drop, right? 58. Nearly half of everything is gone. So why did stocks collapse so hard, so fast, so consistently? Let me walk you through the chain reaction. Step 1. Oil prices go up. That's your trigger. Everything throws from that. Step 2. Energy costs explode across every industry. Airlines, factories, trucking, companies, everything that use energy, which is basically everything, suddenly has costs that are dramatically higher. And when your cost goes up, but your sales don't go up immediately, your profits get squeezed badly. Step number 3, consumers get hit too. Gas lines stretch around city blocks. Americans are waiting hours just to fill up their cars. And why they are doing that? They are spending a massive chunk of their paycheck on gasoline alone. That leaves less money for everything else. Spending slows down, business slows down. 4, inflation explodes. When energy prices go up, prices for almost everything go up. This is called cost push inflation. The government and the Federal Reserve, America's central bank, have to respond. And they respond by raising interest rates. Sounds familiar? I mean, they haven't raised it yet, but they're talking about it now. Step number 5. And this is the killer for stocks. While interests rise, borrowing gets more expensive. Companies can't borrow money cheaply to grow anymore. And here's the other thing. When you can earn a safe guaranteed 8 to 9% return from a government bond, why would you take the risk of owning stocks? Money starts leaving the stock market, and it just keeps leaving month after month. That is a slow, grinding descent you see in that red line. Notice there are some little bumps upward along the way. Investors kept hoping the worst was over. They'd buy on the dips. Then reality would hit again and the market would fall even further. That is one of the most dangerous patterns in investing. What we call catching a falling knife. You think it's a bargain. Turns up, it has further to fall. Okay. So by October 1974, exactly 1 year after the war began, the market finally bottomed. It had lost nearly half of its value. And it would take years for investors to fully recover. Now, there's something really fascinating that most people completely miss when they look at this chart. I want you to burn this into your memory because it's one of the most important relationships in all of investing. The dollar and stocks move in opposite directions. When the dollar surged by 15%, stock crashed 45%. When the dollar eventually came back down after hitting its peak in early 1974, stocks started very slowly and very painfully trying to recover. That inverse relationship, this tendency for the dollar and stock to move against each other is not just a historical curiosity, it's a fundamental pattern that plays out in financial markets over and over again. Here's a simple logic. When the dollar gets very strong, it makes American companies' products more expensive for foreign buyers. Think about an American car manufacturer. If the dollar strengthened, their cost, that costs more for someone in Germany or Japan to buy. Sales falls. Simple as that. A stronger dollar also means any profit the company earns overseas are worth fewer dollars when converted back. So even profitable international companies feel the squeeze. That's the reason why the president and the U.S. administration wanted a weak dollar, although you're not supposed to say that. And there's a deeper psychological element too. When global investors are scared enough to pile into the dollar, when fear is that high, that same fear is pushing them out of stocks. Fear of greed, right? Fear and greed, risk off and risk on. These are the two fundamental modes of the global financial systems. When the world is in risk off mode, when fear dominates, people want safety. Dollars, US government bonds, gold. I don't know. Now it's not really happening. We have to look into that. When the world shifts to risk on, when confidence returns, money flows back into stocks and back into growth assets. Look at this chart one more time. The moment the war starts, it's a massive risk-off event. Dollar surges, stocks collapse. It's literally the chart of a global fear. Just what's happening right now. And the war didn't last that long then. And now we get to the question that actually matters. Because if I've done my job right, you're probably thinking, okay, this is fascinating. This is great, but we're now in 2026. Why should I care about something that happened 50 years ago? We live in a world today where geopolitical tensions, as you could see, are escalating on multiple fronts simultaneously. You have the ongoing conflict in Ukraine. You have what's happening in the Middle East right now with Iran and Israel and the US. You have growing friction between the United States and China over Taiwan. These are not abstract concerns. These are the kind of geopolitical flashpoints that, if they escalate, trigger exactly the same kind of reaction that you're seeing in 1973. That playbook hasn't changed. Energy disruption, dollar surge, stock market decline. What has changed is the speed. In 1973, things played out over months. In today's hyper-connected, algorithm-driven financial world, those moves can happen in days. So what do you actually do with this information? Number one, and my members should know this. Pay attention to the dollar index. Make it an habit to check the dollar index, to DXY, the same way you check your stock market, because a surging dollar is often an early warning sign that something big is happening in the world that could impact your stocks. Number two, don't be alone in stocks. The 1973-74 crash is a brutal reminder of what concentrated stock exposure can do to a portfolio when macro conditions turns against you. Historically, history has shown that assets like gold, certain commodities, and even treasury bonds can provide a buffer during these risk-off environments. Number three, think about energy. Whether you own energy stocks, whether you think about how energy price affect your other holdings, whether you look of how the geopolitical risk in oil-producing region could ripple through your portfolio, energy is a thread that runs through almost every major market crisis in modern history. It was true in 1973, and it's still true today. So let's bring it all together. October 6, 1973, three-week war in the Middle East triggered oil embargo. US dollar surged 15%, crushing stock market by 45%. So this chart that we look at shows you a high story perfectly, right? Two lines. It shows you how geopolitical shock can affect the stock market. That lesson is not that you should panic every time there's a conflict in the world, because eventually it recovers. But the point is that the S&P eventually came back from that 45% drop. But the lesson is that understanding these historical patterns gives you an enormous hedge. When other investors are panicking without understanding why things are moving the way they are, you have the context, the framework. You are calm to make better decisions. That is the idea behind the Black Swan. I want you to understand the risk. So when you're taking a decision, you stick to it and you don't panic because you understand the risk. If you haven't subscribed yet, please do so now. Please join this channel. Understand what's going on. Learn a thing or two about a thing or two. We need more thumbs up. Only 9 thumbs up out of 57 people. Tough crowd. Have $1,000 in Bitcoin. Yeah, I just watched a video about the gold situation 3 days ago. Can I ask a question about gold bullion versus gold miners? Sure. Ask me. It's not the same thing. Jojo, go ahead. What is the question? Is it the same thing? Do they move the same? Well, I will tell you that one basically, there are ETFs that tracks gold bullion, by the way, right? Where you basically own that owns the physical gold. I will say that I have found that the assets, the ETFs that own the actual bullion tend to move higher. So I'm going to choose invest in bullion or into developing in miners. However, I would make the decision miners underperforming more where with leverage. And with new gold deposit discovery, I'm wondering what would be the better. You're asking for financial advice. That's a good point. Here's the thing that you need to grasp. It shouldn't be. I know there's in fact I'm going to do a video on the lack of deposits. I'll do that video next. Actually, I'll set it up. I think I have. I think I did this. Let me make sure I have it. The gold discovery. Yes, I have this. Let me show you right now, and then I'll answer your question, because I think it's important for you to understand it. Look, this is very apropos because I was going to make a video on this anyway. And let me say something about tinkering. Gold discovery worldwide. And the title of this thing is going to be, I'm beginning hearing this, gold miners growing exponentially for a year now. Not happening. Well, that's because the problem is that the dollar gotten too strong recently. And because the dollar got strong, I mean, technically, you should go after gold and after the dollar, but gold miners just something happened there, and the gold got too risky. I mean, they just bypass gold. Technically, gold should be going up. Is the question, is gold about to explode higher? And the data sheet that most investors are ignoring. This is a video I'm going to put together. And we usually look for that, and we do morning video. So let me explain something. Let me set it up. Okay. You have to. Okay. Let me explain something to you. Did you know that most discoveries, most inventions came around literally by tinkering? What do I mean by that? And what does it have to do with your question? Well, you need to understand that when you want to know what to do, when you want to discover something, there's nothing that I could tell you. First of all, I don't want to provide financial advice and say, this is good, this is not good, this is what you should do. It doesn't make any sense because I don't know your financial situation, right? And it's like you have a loaded gun and you say, what should I do with it? I don't know. Can you shoot? You know what a bullet is? You know what the damage it does? You need to tinker. Like, for example, somebody was asking, one of my members asked me, she says, can you put a video together on index, on options? So I could understand what to do with options. So I gave a small video, and then I did the Greeks, so that, but the Greeks basically, the Greeks don't tell you anything. Reading or taking a class in options is not going to help you. The same way, look here, I'll do a live on that. But basically, the Edison, right? The steam engine, all these things were discovered not because somebody say, okay, let me research the topic. No, it was just luck. They were tinkering all the time. We need to tinker. And this is what I do with my members every day. I show them the tinkering, right? I spend a lot of time on this S&P 500, making a lot of money from this thing. Just tinkering with it, right? Understanding it, working it 1 minute at a time, 1 day at a time. You need to tinker. You need to play around. You need to understand. Because you could read a book about gold miners and gold, but you need to know what is going on right now. And right now, technically speaking, the gold should be going up, right? Everybody thinks there's going to be inflation, this scarcity, this fear, right? So you should go after the dollar, technically. And dollar going up, meaning that they're going to have to do inflation. Therefore, the rates are going to go up. So people want to buy the dollar. We are in the early earnings of a secular bull market at gold and silver. We're not talking about meme stocks. Yes, of course. Technically, everything should be going up. Technically. Okay? It's just this thing that was started last week. I don't know what they were thinking. But I know what they were thinking. In simple terms, it makes sense. But you have to realize the implication. Listen to the video I did with game theory, right? They're not playing the same game. You're playing different games, right? And you figure, well, I got to win. I got more weapons. No, but that's not what's happening here. They're fighting the Strait of Hormuz. In fact, it's not even closed, quite frankly. So you're out there trying to destroy them. You don't have enough bullets. Do you know what happens if you run out of bullets? And meanwhile, every day that goes up, every day, right, that this thing goes on, they are winning. They're winning. Why? Because oil is up, oil stays up, and it permeates through the system, right? Because you got to eat. You got to buy stuff. You got to go somewhere where so you're spending that higher amount of money on the oil, and the oil is permeating through the system, making everything expensive. Now you could say, well, that's great. The Chinese are going to get hurt. But they make stuff that you buy. So that stuff is going to be becoming more expensive. Oh, well, it's going to be over next week. Hopefully, right? But even if it's next week, now all of these ships got to make their way out of the strait. And that's going to delay another 2 to 3 weeks. I need to look at the capital I'm willing to risk by investing in miners rather than bullion. I see that miners are more volatile and vice versa by tinkering to my own. Yeah, you need to think. You first of all, you need to look at it. You need to understand how it trades. If it was simple, everyone would be doing it and everyone would be making money. For you to make money, someone is losing money and vice versa. Especially in the options market. Okay. So we are in a situation right now which is getting more and more complicated the longer it lasts. Now, if look at the video I made look at the size of the U.S. and the army. And then it's not just the U.S. You have the U.S. and Israel, both of them. Now, obviously, I'm concerned that Israel is taking care of business, if you know what I mean, in Lebanon. I mean, it's getting a lot. Okay, this started like Gaza all over again. And does the U.S. want to be associated with that? How long? I mean, not going to be good. This is not Venezuela. This is what I said to my member. This is going to be sticky. And the longer it lasts, the stickier it gets. Will you say anything about what is priced in or not? I feel the Canadian. So I can't see on my screen. I feel like Canadian oil companies aren't being paid enough attention at the moment. Would you see anything about what is priced in? And of course, miners' price include leverage at the spot price of gold. We're not sure thing. Research of fundamental. Well, exactly like any other. You can't just. Well, let me buy gold. Miners. But these people don't sit on a pile of gold and just count the gold all day. They gotta, they've got expenses. Where are they located? Why do you think emerging markets are hurting right now? Right? They were doing great with gold before when gold was going up because, there's a lot of them actually mine gold in emerging markets. But now they're getting hurt. Well, they're still mining gold. Why is gold going down? I don't know. I don't know what gold's going down. If I knew, I would do something about it. I mean, I bought some gold earlier. I don't know. I'm going to have to tinker with it for a while. I'm going to see it every day. As my members know, we go through all those things. Okay, what happened? What's going on? What does it mean? What happened? What's going on? What does it mean? What happened? What's going on? What does it mean? And of course, every day things change because people are doing things. Sometimes they're not doing things. And by the time we're done with us, we have to worry about the inflation. And what is the market going to do? What are all these people going to do? And when I see people telling other people, okay, this is what you should be doing, this is driving me mad because that should be illegal. Right? Technically, it is kind of illegal at the end of the day. It's like you giving advice on brain surgery on YouTube. And they keep saying, people, I'm just telling you, this is entertainment only. You have to tinker. You need to, you could take classes and work with. The only thing is, that's why I created this channel because I taught classes. But the only thing with the class is, it's not the same, right? You need to tinker. You need to go like one thing at a time. Let me show you 4 things, not 50 things. And when you teach a class, you're showing 50 things. Yeah, largest expense for miner is fuel. Exactly. You need to learn a few things. You can't learn everything. So what I do with my members, right? I go in and I say, okay, this is what's happening to the dollar. This is what's happening to the 10-year yield. And why is it going up? Let me see. Well, it looks like this. Right? The market is talking to you. You just have to listen to it. But you have to understand it. You can't read a book about it. No. In fact, I was reading the Black Swan again today, and I want to do a video on that, a live, because there's a lot of that stuff is true. For example, the tinkering business is true. I mean, look, just Google it. Google it. Go on Agent in AI. Ask ChatGPT how were the most important invention, how do we come up with the most important invention in the world? And you find out that it was just by luck. People were tinkering about things and then they found something else. That's what I do with this channel, right? I'm tinkering all the time. I'm thinking, okay, what are we talking about? What should we talk about? What is the best way to approach the people? How to explain what setup, what the chart is best, or put a bunch of videos in the background, or what do people, I've been tinkering for 3 years. 3 years. Look at in my history. Look at the first video I did. I took the video when I was traveling the world, doing a kind of thing. What do people want to hear? And that's important. So let me do this video for you. Let's talk about you want to talk about the gold mine. It's perfect. Let's talk about the gold mine. The gold discovery. We are going to talk about gold. We are going to talk about silver. We're going to talk about the companies that dig these metals out of the ground, the miners. More importantly, we are going to talk about why right now, at this exact moment in history, most of us are not holding enough of them. Not even close. I'm sure, some of you are thinking, gold, really? That's kind of, you may want to stick with me, because I'm going to walk you through something that changed the way I personally think about money, wealth, and protecting what I have. So let's start at the beginning. Let's talk about what is actually happening in the world right now, because everything we are going to discuss today connects back to the big picture. We live in a world right now where things feel unstable. I think most of us can feel it even if we cannot fully explain it. Wars happening in different parts of the world, countries that used to get along are now at each other's throats, political tension, not just between countries, but inside countries. We're at levels we have not really seen in decades. And then there is money. The amount of debt that government around the world are carrying right now is absolutely staggering. The United States alone is carrying a national debt that is in the tens of trillions of dollars, and it is not just America. Look at Japan, look at Europe, look at developing nations. Everyone is buried in debt, and when you are buried in debt, you have a problem, because debt costs money. You have to pay interest. And when interest rates are high, the interest payment gets bigger and bigger every year. This matters. It really matters, because it forces governments to make choices that end up affecting all of us, especially people who have saved money, investing money, and are trying to build wealth for their future. So with all of this happening in the background, I want to walk you through 6 specific things, 6 forces that are all moving in the same direction at the same time. And when all 6 of these forces line up together, history tells us that gold and metals do well, very well. So let's get into it. Let's talk about geopolitical risk again, because that's accelerating. It's just a fancy way of saying the world is getting more dangerous and more unpredictable. Think about what we've just seen recently, right? Conflicts breaking up everywhere. Major world power repositioning themselves. We haven't heard about China and Taiwan, but hold that thought. Countries that used to be allies are now questioning their relationship. Now, this is why gold matters specifically. When the world gets uncertain, when people do not know what is going to happen next, they look for safety. They look for something that has held its value for thousands of years. And that thing is gold. Now, obviously, in the US, they may think that, safe. But in other countries, that is not the case. Gold has been used as a store of value for over 5,000 years. It does not belong to any government. It cannot be printed. It cannot be devalued by politicians signing a piece of paper. When things get scary, gold becomes more attractive. And right now, things are getting scarier by the month. Number 2, central banks are accumulating gold. This one is huge. And I think it's one of the most underreported stories right now. Central banks, these are the big banks that control the money supply for entire countries, like the Federal Reserve in the United States or the European Central Bank. These institutions are buying gold at a pace we have not seen in decades. Think about that for a second. The very institutions that are in charge of managing money, the people who create the money, are choosing to hold gold. Why would they do that? Why wouldn't they just go out and print some more money, right? Why would they go out and buy gold if they can't just print more dollars or euro or yen? The answer is trust, or more specifically, the lack of it. Central banks around the world are quietly saying with their actions that they do not fully trust each other's currencies the way they used to. And so they are diversifying. They are holding gold as a backup, as insurance. And when the world's biggest, most sophisticated financial institutions are doing the same thing, you have to ask yourself, why should I be paying attention? Number 3, governments are building strategic resource reserves. This connects directly what I just talked about, but it goes even further. It's not just gold. Governments around the world are stockpiling strategic resources. Copper, silver, lithium, rare earth metals. Why? Because these materials are critical to modern life. They go into everything. Electronics, electric vehicles, military equipment, solar panels. And countries have realized that if you do not have access to these materials, as the US found out very recently with its discussion with China, you are vulnerable. You can be cut off. You can be pressured. You can be weakened. So nations are building reserves. They are trying to secure supply chains. And this creates enormous demand for metals. Demand that is not going away anytime soon. In fact, it is growing. Force number 4, no major new metal discoveries being made. Okay, now we're getting to something that I think is genuinely underappreciated by most investors. And this is where the charts we are going to look at the moment becomes really important. Here's a simple reality. Finding gold and other precious metals in the ground is getting harder, much harder. The easy discoveries, the deposit that was sitting close to the surface is in inaccessible spots. Most of those have already been found. Miners today are having they have to dig deeper. They have to dig deeper, go to more remote locations and spend far more money just to find something. And even when they do find something, it takes years, decades, to actually build a mine and start producing. The data is very clear on this. Major gold discoveries defined as finding at least 2 million ounces of gold in one location has been declining dramatically. And I mean dramatically. Let's look at this in detail when we go through the chart. What this means is simple. The supply of new gold coming into the market is going to be constrained for years, possibly decades. And when supply is constrained but demand is growing, you do not need to be economist to know what happens to the price. Number 5, no large-scale producing projects coming online. This one is connected to number 4, but it deserves its own spotlight. Even if a mining company finds gold, the process of going from discovery to actually pulling gold out of the ground is incredibly long and expensive. We're talking about environmental permits, community consultations, equipment, infrastructure, sometimes building roads into remote areas, sometimes building an entire camp for workers in the middle of nowhere. Average time from discovery to production is somewhere between 10 to 20 years. 20 years. So even if a company found something today and we are about to see it, they are not really finding things, it would not hit the market for a very, very long time. This means the supply pipeline for gold is essentially running on empty. The mines that are producing today are getting older. They are producing less, and there is nothing significant waiting in line to replace them. This is a supply crisis that's developing slowly, but it's very, very real. In fact, my members will see every day I show them about that particular investment that I think is going to do well at some point, and I'm going to buy more actually on Monday because it's down about 35%. Countries are being forced to cut rates to manage their debt. That's force number 6. And here's the last piece of the puzzle, and in some ways it might be the most important one. Remember I talked about all that government debt? Well, here's a problem. When interest rates are high, the cost of carrying that debt goes up. The government has to pay more interest, and at some point the interest payment gets so large that they crowd out everything else, education, healthcare, infrastructure, defense. Everything starts to suffer because so much money is going just to service the debt. So government and the central bank that answers to them are going to be under enormous pressure to cut interest rates, to bring rates down so that debt becomes cheaper to carry. Now, here's why this matters for gold. Gold tends to do very well in low interest rate environment because when rates are low, the things you normally park your money in, like savings account, government, barely pay you anything. They do not keep up with inflation. So investors start looking for real assets, things that hold real value, and gold is at the top of that list. So we have this situation where governments need lower rates, and lower rates at exactly the environment where gold historically performs the best. I would like you to remember to subscribe to this channel. Thumbs up, please. Thank you. And if you want to know more, join the rest of my members so we could tinker together every morning and try to figure out what's really going on here and make some money. Okay, before we get into the chart, I want to tell you that to subscribe. So let's get into the chart. That's how I already ask you to subscribe. Let's talk about this chart. The title is called New Gold Discoveries Worldwide, and it comes from S&P Global, which is one of the most respected financial data companies in the world. So this is not some random, blog post, right? This is hard data. Let me walk you through how to read it because charts can sometimes feel confusing. But this one is actually really straightforward, right? Along the bottom of the chart, what we call horizontal axis, we have years, and it starts from 1990 and it runs all the way to 2024. So we're covering 34 years. Along the left side, what we call the vertical axis, you have numbers 0 to 30. These numbers represent how many significant new gold discoveries were made in that year. Start to get the picture. Specifically, it is counting discoveries for at least 2 million ounces of gold. So we're not talking about someone finding a tiny packet of gold, right? We're talking big stuff. Each year is represented by a blue bar. A taller bar means more discoveries were made that year. A shorter bar means less. Now, here's what makes this chart so powerful and honestly a little alarming. Let me walk through it. If you look at the early 90s, the bar was climbing. You have 10 in 1990, 12 in 91, 23 in 92. The world is making significant gold discoveries pretty regularly. Then you peak around 1995. 20 discoveries in a single year. 28. That's extraordinary. The mining industry is at the height of its discovery cycle. From there, start to come down a little, but they are relatively healthy through the late 90s and early 2000s. You still see years where you have 17 to 22 discoveries. Still meaningful. Then something starts to happen as you move into the 2010s. The bar starts getting noticeably shorter. The numbers are declining. Fewer and fewer significant discoveries are being made each year. The world is not finding new major gold deposits the way it used to. And then it goes, it collapses 3, 3, 2, 1, 1. And then you get to the final two bars in 2023, 2024, and the two bars is just zero. And next to those zero bars, a chart is noted in yellow that says 0 major discoveries in 2 consecutive years. This never happened before. Let's let that land for a second. In 34 years of data, going back to 1980, this has never happened before, not once. There have always been at least some discoveries, but in 23 to 24, nothing. Now, how does this matter so much? Think about it this way. A gold mine has a lifespan. It produces for a certain number of years, and then it runs out. If you want to keep producing gold over the long run, you need to keep finding the deposit, like a factory. This is a situation the gold industry is heading toward. That existing mines are producing, yes, but they are getting older, and nothing meaningful is being discovered to replace them down the road. This is a slow-moving supply crisis. Does not hit overnight, but it's absolutely real. So let me put it all together to you, because I don't want you just, a list of problems. I want you to see why all of this matter at one time. On one side, we have demand that is growing. Central banks are buying gold. Governments are stockpiling. Geopolitical tension are pushing, right? And interest rates are getting pushed lower, which historically sends more money flowing into gold. On the other side, we have supply side that is shrinking. A discovery drought that is literally unprecedented in modern history. When you put growing demand in one side of a scale and shrinking supply on the other, only one thing can happen. The price has to adjust upward. It is not my opinion, that is basic economics. And this does not just apply to gold as a physical metal. It applies to the mining companies. The businesses that dig gold in the ground. Here's something that a lot of people do not realize. Mining stocks, companies that produce gold and silver, are what is called leveraged to the price of the metal. That means when gold goes up by a certain percentage, mining stocks tend to go up more because the profit margins of these companies expand very quickly when the price, what they sell, goes up. Think of it this way. If it costs a mining company $1,200 to pull 1 ounce of gold out of the ground and gold sells for $1,500, they make $300. If gold goes up to $2,000, their profit jump $5,000, even more. That is why historically in bull market for gold, mining stocks tend to massively outperform the gold price itself. The companies don't just go up with gold, they go up much more. Now, have an honest conversation here, because I'm not here just to pump you up and send you running to buy something without thinking through. This is not what this channel is about. There are real risks here. Mining is a difficult business. Projects get delayed. Costs go over budget. Political situation in certain countries can create problems. There will be days when things drop and you question everything. That is what I always say. This kind of investment is about conviction. Understanding the risk. If you understand why you own something, you can hold it through the volatility. You understand the risk. But if you just heard someone online say, hey, gold is gold, gold's going to go up, let's buy it. Understand these theses. The 6 forces we talk about today, the discovery, the supply, demand, that is what gives you the conviction to stay the course. So let me leave you with this takeaway. None of us own enough metals and miners. That line does come from me. It came from the slide we looked at today. And when you think about everything we covered, geopolitical, the rate cut, the discovery, that line starts to feel less like an opinion and more like a warning. We are in a window right now, window where those assets are still underowned, still undervalued relative to the macro forces. I mean, I'm not saying go out and buy all the gold in the world, but think of what you're watching this video all the way through. That genuine means a lot to me. And this, if this gave you value, I want you to appreciate it and let someone know about it. And I want to help the people understand what they do with their money. This is very important. Yeah, yes, you're supposed to bring a mind to discover. Okay, everyone. We'll see you tomorrow. And Monday for my Monday for. How do you know? How do you know what is already priced in or not? You know, these 6 forces are not secret. Why don't you join us so we could talk about it as members? I mean, you have lots of questions. Yes, it's not a secret, but you'll be surprised what people don't realize what they can do and what's happening. Maya, I hope you're safe over there.